Good afternoon, distinguished members of the press, ladies and gentlemen. By way of background, the Monetary Policy Committee, MPC, met on the 21st and on the 22nd of November 2018 amidst a resurgence of global inflationary pressures, increased fragilities in the global financial markets, weakening crude oil prices, and continuous capital flow reversal and moderate currency depreciations, especially in the emerging markets, as well as strengthening US dollar and subdued global economic growth outlook. The committee appraised recent developments in the global and domestic macroeconomic and financial environments, as well as the economic outlook for the first half of 2019. In attendance were 11 members of the committee. Global economic developments. The committee noted the contraction in global output, underpinned largely by escalating trade tensions resulting in widespread uncertainty and waning investor confidence. Consequently, global growth in 2018 has been downgraded to 3.7% from the earlier projection of 3.9%. Growth softened in major advanced economies in the third quarter of 2018, and in the emerging and developing economies, growth remained divergent, reflecting a combination of country-specific factors. Thus, growth in the advanced economies is expected to remain at 2.4% in 2018, supported by strong output growth of 2.9%. The U.S. expansionary fiscal stance, strong wage growth, and continued inflow of capital into the US dollar-denominated assets are expected to provide the impetus for growth. In the United Kingdom, growth remained weak, hampered by uncertainties around the Brexit negotiations. Growth in the euro area, projected at 2.0%, appears to be subdued by low domestic aggregate demand amidst relatively high unemployment and reduced global trade. In the emerging market and developing economies, growth was revised downwards to 4.7% from the earlier projection of 4.9%, largely in anticipation of a slowdown in China as it is confronted with an adverse external trade environment. Overall, the downside risks to global economic activity remained elevated financial fragilities and policy uncertainties, the gradual erosion of rule-based multilateral trading system, tighter financial conditions with latent disruptive portfolio adjustments, increased capital flow reversals with potential for heightened exchange rate depreciation, and some volatility, fiscal fragilities, and increased debt burden, geopolitical tensions, and increasing depressed aggregate demand in some countries. These factors will continue to shape developments for the rest of 2018. And MPC also noted that monetary policy in most advanced economies, particularly the United States, continued on a path of normalization in view of strong wage growth and declining unemployment. The Bank of England hiked its policy rate in August 2018, while the European Central Bank, ECB, has given guidance to terminate its assets purchase program in December of 2018. The committee was concerned that these developments will, in the medium term, accentuate capital flow reversals from emerging and developing economies, including Nigeria. Domestic output developments. Committee noted the positive outlook for output growth, evidenced by the manufacturing and non-manufacturing purchasing managers indices, which stood at 56.8 and 57.0 index points, respectively, in October 2018, indicating expansion for the 19th and 18th consecutive months. This was attributed to the stability in the foreign exchange market, implementation of the 2018 capital budget, and the ongoing intervention of the Central Bank of Nigeria in the real sector of the economy. However, the recent incidents of flooding across the country and the impact of herdsmen attack on farming activities could affect output growth for the rest of the year. Overall, the committee believes that even though output recovery remains fragile, the effective implementation of the 2018 capital budget, relative improvement in power supply, progress with counter-insurgency in the northeastern and sustained intervention by the CBN in the real sector will improve the investment climate and reduce unemployment. Consequently, the MPC reaffirmed its support for all initiatives designed to stimulate domestic output and growth. Developments in money and prices. The committee noted that broad money M2 grew by 6.52% in October 2018 over its level at the end of December 2017 and annualized to a growth rate of 7.82%, which was below the provisional benchmark of 10.48% for 2018. The growth in M2 was largely due to the significant growth in net foreign assets by 20.71% in October 2018, annualized to 24.85%, which is above the 2018 provisional growth benchmark of 14.50%. Credit to the government and net domestic credit expanded by 7.43 and 2.71% annualized to 8.92 and 3.26% respectively, but below the annual benchmark of 13.1 and 17.4% respectively. Credit to the private sector grossly underperformed as it grew by 1.494% annualized to 2.33%, below the 2018 benchmark of 12.4%. The underperformance of the monetary aggregates was of concern to the MPC, which urged the CBN to ensure improved credit delivery to the small and medium-scale industries, particularly to the unbanked, urban, and rural populations. The committee noted the benign performance of inflation as headline inflation year-on-year decreased to 11.26% in October 2018 from 11.28% in September 2018 after 2 consecutive months of marginal increases. The drop in the headline inflation was driven by food inflation, which moderated to 13.28% in October from 13.31% in September 2018. Core inflation, however, inched up marginally to 9.9% in October 2018 from 9.8% in the previous month. On a month-on-month basis, headline and food inflation also moderated to 0.74 and 0.82% in October and from 0.84 and 1% in September 2018 respectively, while core inflation increased from 0.64% in September 2018 to 0.8% in October 2018. The committee noted that the moderation in inflation was largely seasonally driven and was therefore unsustainable as prices were expected to peak towards the end of the year. However, the MPC observed that the near-term upside risks to inflation remained, the disruption of agricultural production and distribution arising from flooding, insurgency in the northeast, herdsmen and farmer crisis, high cost of energy, anticipated spending in the run-up to the Christmas festivities, and campaign-related spending towards the upcoming 2019 general elections. Accordingly, the committee enjoined the appropriate authorities to continue to address these challenges and to sustain the implementation of the 2018 budget and the Economic and Recovery and Growth Plan of the federal government to ameliorate the supply-side constraints. Money market interest rates oscillated throughout the review period, reflecting fluctuations in banking system liquidity. Interbank call and open buyback rates, which stood at 16 and 17.08% on September 26, 2018, declined moderately to 14% and 16.31% respectively on October 24, 2018. On average, interbank call and OBB rates rose from 8.68 and 7.64% in September 2018 to 14.18 and 13.93% respectively in October 2018, closing at 10 and 9.72% in November 21, 2018. The developments in the net liquidity positions and flows, which culminated in higher market rates, reflected the impact of higher risk perception in the market, withdrawals from the banking system for monthly statutory disbursements to states and local governments, open market operations sales, and foreign exchange interventions. The average Naira exchange rate remained relatively stable and converging at both the borrowed exchange and the investors and exporters window segments of the foreign exchange market during the review period. The exchange rate at the investors and exporters window opened at 364 Naira to the dollar and closed at 363.9 Naira to the dollar, with a daily average of 363 Naira.87 to the dollar between September 26th and November 16, 2018. At the broad exchange segment, the exchange rate opened at 360 Naira to the dollar and closed at 361.85 Naira to the dollar, with a daily average of 360.98 Naira to the dollar over the same period. The relative stability in the foreign exchange market, the MPC noted, was attributable to the sustained policies of the bank to increase the supply of foreign exchange from the autonomous sources. Gross official reserves decreased from $42.6 billion at the end of September 2018 to $41.53 billion on 16th of November 2018. Committee noted the bearish trend in the equities segment of the capital market during the review period. The all-share index decreased by 8.7% from 34,848.45 on August 31, 2018 to 32,058.28 on November 16, 2018. Similarly, market capitalization decreased by 8.72% from 12.72 trillion to 11.7 trillion during the same period. Relative to the end of December 2017, the indices decreased by 19.29 and 16.32% respectively. These developments largely reflect the sustained profit-taking activities by portfolio investors as foreign yields become increasingly more attractive abroad. The MPC, however, believes that this trend will reverse in the medium term given the current efforts at further improving investor confidence and the relative stability in the investors and exporters window of the Nigerian foreign exchange market. Overall outlook and risk. Forecasts of key macroeconomic variables indicate a positive outlook for the economy during the fourth quarter of 2018. Committee expects that the effective implementation of the Economic Recovery and Growth Plan and the 2018 budget, improvements in the security challenges, enhanced flow of credit to the real sector, and stability in the foreign exchange market will redirect the economy on a path of inclusive and sustainable growth. Improvements in productivity in the oil and the non-oil sectors are also expected to drive output growth in the medium term. The committee, however, acknowledged the downside risks to this outlook to include reduced portfolio inflows, absence of fiscal buffers, low domestic credit, and weak aggregate demand. The inflation outlook suggests continued but moderate inflationary pressure to the end of 2018, based largely on increased consumer spending for the Christmas festivities, election-related spending, and increased pace of implementation of the 2018 federal government budget. Improvements in the security, increased harvest, as well as stable exchange rate are expected to moderate the rise in inflation. Overall, the outlook for the economy remains positive with a growth projection of 1.75% in 2018. Committee's consideration. Committee assessed the macroeconomic environment in 2018 and noted the modest stability thus far achieved in domestic prices, output growth, and the financial system. Committee noted that the economy was on the right path, but some key sectors continued to experience significant challenges. The MPC, however, expressed concern about the tepid growth expectations and growing uncertainties in the global financial markets arising from the poor reception of the Brexit deal by the British politicians, the continuing trade war between the US and her major trading partners, as well as the commencement of US sanctions on Iran. The committee believed that although the domestic economy was recovering modestly from recession, however, the recovery was tepid and efforts should be stepped up to strengthen the domestic aggregate output and demand. In this regard, the committee urged the bank to deepen and broaden access to finance to high employment elastic sectors with particular emphasis on small and medium-scale enterprises. The committee called on the bank to extend the success recorded under the Anchor Borrowers program to other items including fish, palm oil, and etc. by introducing more stringent measures to curb access to foreign exchange for products that can be produced within Nigeria. The MPC welcomed the moderation in inflation in October, reflecting declining food prices. The committee believes that given the negative output gap, the proposed increase in the national minimum wage will stimulate output growth due to prolonged weak aggregate demand, due to salary arrears and contractor debt. Consequently, its impact on aggregate price level will be largely muted, given that monetary aggregates have largely underperformed in fiscal year of 2018. In addition, the prevailing stability in the foreign exchange market would continue to moderate pressures on the domestic price levels. The MPC noted the improvements in the financial stability indicators, including non-performing loans, capital adequacy, and liquidity ratios of the deposit money banks. It urged the bank to sustain its surveillance over the banking system by taking prompt corrective measures to further improve stability in the system. The committee also called on the fiscal authorities to build significant buffers to strengthen the efficacy of monetary policy. Overall, the Monetary Policy Committee considered the options of either to loosen, hold, or to tighten. The committee continues to hold the view that although loosening would encourage the flow of credit to the real sector, help in reduction of the aggregate cost of credit and spur business spending and investment, thereby reinforcing the CBN's support for output growth and economic recovery, it however believes that doing so would reverse more rapidly the gains of price and exchange rate stability achieved so far, given the liquidity impact that would entail. The ensuing liquidity will exert pressure on the exchange rate in the light of increased capital flow reversals arising from monetary policy normalization by the US Fed. This will further depress the capital market. As for tightening, the MPC holds the view that while tightening will strengthen the stability of the foreign exchange market because of its dampening effect on the demand for foreign exchange, it was however convinced that this would simultaneously dampen investment growth, widen the output gap, depress aggregate demand, and weaken output growth. The MPC recognizes the fact that it had held the policy rate and other policy parameters constant over the last several meetings. Committee underscores that by holding its policy positions constant over this period, it has confidence in the various policies and administrative measures deployed by the bank, which have resulted in the moderation in domestic price levels and stability in the foreign exchange rate. Thus, a hold position is an expression of confidence in the policy regime, given the gradual improvement in both output growth and price stability. On this premise, the downward risks to growth and upside risks to inflation appears contained. Committee's decision. In the light of the above, the MPC decided by a vote of all 11 members present to hold. In summary, the MPC voted 1. To retain MPR at 14%, 2. Retain the asymmetric corridor at plus 200 and minus 500 basis points around the MPR, 3. Retain the CRR at 22.5%, and 4. Retain liquidity ratio at 30%. I thank you for listening.